Hi everyone, it's Jack back on a video. Today I'm going to be talking about a really interesting business. It's a UK REIT. I've been spending a lot more time looking at REITs, particularly in the UK, because the valuation is just so attractive in this higher interest rate world. And we're looking at Tritax Big Box REIT, currently trading for about £1.40, way off its 2022 highs of in the £2.50 range. And it doesn't take a genius to work out that. It's because we're in a higher interest rate environment. Their interest payments going up and their earnings will come under pressure. That being said, they've recently just increased the dividend, still looks strong despite the drop. We're at nearly 5% right now. A lot of things look good. I want to go through this company's recent earnings, go through kind of the reasons to invest in this company, its diversified range of customers, blah blah, look at the balance sheet, look if I think there's any serious problems with this business, and decide whether I think it's a buy, sell or a hold going forward. Before I get into the financials, I want to first look at its range of customers, because I think this gives really good insights into the business model at Tritax. So 21% of their entire customer base is online retailers. 14.5% of all customers is Amazon. That's 3 times more than the next largest, or almost 3 times more. Next and Ocado make up the rest of that online retail percentage, or they are the largest customers. This is part of the reason that Tritax is getting hit by analysts. They're dropping estimates. Basically, they believe there's going to be a slowdown in online retail, and there has been a slowdown in online retail growth. That is undeniable, but I think you will be hard-pressed to believe that this is going to last for many, many years. I think in the short term, Tritax has been hit because of this, but over the next 5-10 years and onwards, I think this can only be of benefit to this business, having a presence in online retail. That being said, it's a clearly well-diversified business. Food retail makes up 17% of its customer base. I think this is really bullish actually, because these are often big box. They are long-term leases, very rarely close-up shop. How often do Tesco's move around because they are such large sites? Next, homewares and DIY. Again, very large, big box retailers. B&Q, Screwfix, Dunelm. These are big names. I would argue out of the top 10 customers, all of these are household names and companies that I don't think there will be any problem with, other than perhaps Howdens, which is having a tough time at the minute due to the interest rate environment. But you look across the distribution of large customers, and most of them are big box retailers or high-end grocery stores. I think the only Howdens and Argos I think will possibly come under pressure, but the rest of them I think are almost blue chip names in my opinion. So now we've established that the majority of its customers are what I would describe as blue chip companies that are probably not going to have any trouble paying the rent anytime soon and have decent growth trajectories ahead of them. The next question mark is of course the balance sheet, and when you look at this, it looks pretty good. They have an interest cover of 4.8 times, available liquidity of over £500 million, which versus current market cap is about 1/6 or something like that. Average debt maturity of 5.4 years, which is decent, not particularly ideal, but okay. This is the key thing for me. Average cost of debt, 2.6%. A lot of the worry around this company is that interest rates are rising. Currently, inflation is at 10% in the UK, or most of its assets are in the UK, and interest rates at 4%, likely to rise higher. But as of 31st December 2022, average cost of debt, just 2.6%. This may have rose a little bit, but I doubt it's at the current interest rates of 4%, maybe in the 3% range. They've not reported on this as of yet. But still, I think this is very impressive. They have a corporate credit rating of Baa1, which is decent. Not ideal by any means, but very good. In terms of balance sheet, I'm not overly worried about this business. It has a 31.2% loan to value at the 31st December. And while the net asset value has decreased slightly, I'm very happy with this business. I think its diversified and long-term portfolio is going to be easily covered by this balance sheet. Another note is they're not only diversified by businesses, tenants and sectors, but by location, are widespread throughout the UK with a large concentration in the southeast at 33%, but overall a decent mix, diversity in sizes, very strong EPC ratings, and an average building age of just 10 years, very, very strong, 44% under 5 years old. This is exactly what I want to see. And the financial results for 2022, in my opinion, were actually pretty good and show how overstated this stock drop has been, in my opinion. Contracted annual rent of 224 million, that's up 14.5%. Net rental income up 11.6%, up to 206 million. Operating profit £183 million. That's up 2.9%. Adjusted earnings per share were down 5.3%, and I think this is where a lot of the fear around this business came from, and I'll explain that on the next slide in a minute. Average share count has increased 6.4%. Dividends per share increased 4.5%, which is exactly what we want to see. The payout ratio has crept up, which again is exactly what we want to see here. All in all, apart from the adjusted earnings per share, which I'm going to explain in a second, this is pretty much business as usual for a REIT like this, and probably pretty much exactly what we want to see. These four graphs, I think, really outline the strength of this business. Contracted rent, adjusted earnings per share, net asset value and dividends per share, which for the most part are up and to the right. The exception being net asset value, which as the general property market in the UK has decreased because of interest rate rises, has fell. However, that's came in line with share price, and this business is still trading at a 20% discount to net asset value. Adjusted earnings per share is the one I want to focus on here. You can see in the dark blue, this is essentially earnings per share from rental income, and in the highlighted section, that is additional DMA, which is management fees, so associated management fees with some of these buildings that they have. Now this is variable, and this has decreased this year, but the whole, and what we really should be focused on, because it's the majority of the revenue and therefore earnings, is the net rental income, and that attributed to earnings per share is still increasing and still up and to the right. Dividends, of course, have also increased over the long term, despite a drop-off in 2020 for obvious reasons. This continued, and the general trend is upwards, and that's exactly what I want to see. I think overall I've explained why this is an attractive business, and why I think Tritax are attractive owner-operators. What surprises me is the discounted net asset value that is available here because of the fear in the market. This is the same across many REITs. I think this business is very similar to the likes of Realty Income in the US, where perhaps without the same pedigree. However, it's just not trading for the same premiums. The premium discount here is 23%. That's incredible discount to net asset value that is very rarely seen in the REIT business, except for extremely distressed assets, where this absolutely isn't. As early as March last year, so this time last year, it was trading at probably a 10% premium to its net asset value, and now it's at a nearly 25% discount. To me, this is a classic example of a time when it is important to be greedy when others are fearful. I think this is a company that can well bounce back in the next 2 to 3 years. I'm very happy to be buying at these prices, especially to lock in that juicy dividend yield of nearly 5%. This is why I've been adding it to my UK dividend portfolio. I think there's a high quality company with exceptionally strong tenant base that is trading at a really quite aggressive discount to net asset value. I think this is a great opportunity. I think within 5 years, I think it'll be close to its 52-week highs again. The 4% interest rate environment is absolutely not ideal for a business like this. Of course, interest rates have the potential to rise in the UK. That is an inherent risk. However, I think Tritax's balance sheet is more than mitigated for this. I think its strategy is more than mitigated for this. I think in the long term, it will not really have an effect on this company. If interest rates being in the 4, 5, 6% range is the new normal, then this business will not be making the same earnings it was a few years ago. However, I still think over the long term, this will be a fantastic business to hold regardless. And I think that is why I'm going to be buying it. Probably pretty aggressively. I started off with a small position, but I think I might build it out to 7 or 8% of the portfolio, depending on how the stock price changes in the next few weeks and months. Of course, that being said, I'm not a financial advisor. You should not take this as financial advice. You should do your own research and due diligence. And let me know about it in the comments down below. Let me know what you think of this business. Let me know what you think of other REITs and other dividend stocks in this space. Let me know in the comments down below. Like and subscribe if you're enjoying the video. I'll see you again next time.